Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing the benefits of a Roth IRA. Now, if you've watched this channel for a hot minute, you know Brian is a huge fan of the Roth, right?
Really? Yeah, now you know I am.
You need one of those baseball mitts. It's like Roth IRA.
The foam, the finger,
The foam ones, the foam fingers.
Yeah. It's funny, Michelle. In my opinion, though, opening and funding a Roth IRA may be one of the best moves someone can make financially. Not only does a Roth allow you to grow your money tax-free, but because Roths are funded with after-tax money, then your withdrawals in retirement are also tax-free. So a Roth IRA is also more flexible than other retirement accounts like your 401k, 403bs, and you can invest in almost anything like stocks, bonds, mutual funds, ETFs, and even real estate. So,
that's the big difference. A lot of people will write and ask us, or I just have friends who will say, hey, what's the difference between the traditional IRA and the Roth? And the biggest difference is the tax benefit, right? That withdrawals in retirement are tax-free. It's a massive benefit, especially when we don't know what taxes are going to be like in 10, 20, 30 years down the road.
Right. And besides the taxes, there's a lot more advantages to having a Roth IRA.
Okay, so before we dive in and we get to that, let's talk about that. If you like the content of this video, go ahead and hit that like button, help us grow this channel. And also don't forget to subscribe so you never miss another video from us on how to stop being a transaction and start to become a more informed consumer. All right, so Brian, the floor is yours. Let's start with advantages. What are all the advantages other than the tax-free withdrawals?
Yeah, there's 5 main advantages to the Roth IRA. First, like the tax-free distributions that we've talked about. That's the number one benefit of a Roth IRA. Like I said before, you funded these accounts with after-tax money. In retirement, your proceeds will be yours free and clear of all taxes. This is huge. The key, though, is to make sure you hold the account for 5 years or longer and be above the age of 59 and a half when you start your withdrawals. Okay. Second, no required minimum distributions. Unlike the traditional IRA, your required minimum, your RMDs, which are your required minimum distributions, are required, right? These, this allows your funds to continue to grow tax-free without being forced to liquidate them, right?
Yeah.
So that's the next big one.
Okay, third.
How about better terms for early withdrawals than an IRA? Okay. And I like this because, Michelle, let's say you need funds for an emergency, right? You're not going to be penalized for early withdrawals of your contributions to a Roth IRA. Okay. The 10% penalty will only be on the earnings if they are withdrawn prior to age 59 and a half. So any withdrawal from an IRA before 59 and a half, you have a 10% penalty and you must pay income taxes on the amount withdrawn. Okay. There's the third difference.
Okay.
How about on the fourth advantage, Michelle? How about tax-free withdrawals for your heirs?
That's a big one.
This is huge. Unlike traditional IRAs, your heirs will pay no taxes on the proceeds from an inherited IRA or Roth IRA. That's a big difference.
So it has to be an inherited Roth IRA, not
Roth IRA. Yes.
All right.
And the last big advantage of a Roth IRA that we'll discuss today is they're easy to open. Almost anyone can open one as long as you have earned income. Your contribution limits for 2022 are $6,000 and $7,000 if you're over 50 years old.
So you have to make that. You have to make $6,000 worth of earned income to be able to contribute. That's
yes.
Right.
You must have the earned income at least to the maximum of what your contribution that you put in. So
I also have, speaking of contributions, one of my addition to the advantages here is that, you have until the next tax deadline to add to your Roth IRA to contribute, right? So if you haven't done it in the calendar year of 2022, you have until April tax deadline 2023 to max it out, right? Is that right? 2023?
Yes, that's correct.
Oh, where has the time gone? All right. So you mentioned before, there are specific rules, on withdrawing, but what about more specific rules on who can contribute to Roth IRAs for specifically phase out rules? Can you walk us through that and explain it.
Yeah, the phase out, Michelle, is for those that might make a little too much money. And there's a phase out range, especially think about married couples. Married couples filing jointly are covered. And if you're covered by a workplace retirement plan and you contribute to a Roth and for this year, for 2022, that range of income, Michelle, is between $204,000 and $214,000. It phases out. Okay. And for heads of household or those filing as single, the 22 phase out range for income is $129,000 up to $144,000.
Are these ranges before or after taxes?
This is what's your modified adjusted gross income, which means after all deductions and write-downs allowed by IRS, like IRA contributions, student loan interest, and they're usually line items on the front page of the tax form.
Okay. All right. So just so we're super clear here for viewers, if I'm the head of the household or I'm filing single, right? And I know that I'm making $130,000 in 2022. Will I have to pay the penalty? Because I believe you said the phase out is between 129 and 144 for single or filing as head of household. So how does that, do I have to pay a penalty? Can I only contribute a specific amount?
Okay. Yes. Great questions. And this comes up quite often. If the amount you can contribute must be reduced, you have to figure reduced contribution limit. That's what you're talking about here. But also, you're also talking about a penalty. So let's break this down step by step. Okay. Let's start with your modified adjusted gross income. And what you have to do, Michelle, is subtract the amount in whatever it is. So let's take your case, for example, 130,000. Okay. We said the amount was 129 was the phase out, right?
Right.
So you guys subtract the 129, which leaves $1,000, right?
Okay.
Okay. Now you have to multiply that, or what, we have to divide it out by 15,000 because you're filing single or head of household this year.
Okay.
Okay. And then that equals 0.066. So we take your 1,000 that you've allowed, 0.066, which is 1,000 divided by 15,000. It's a complex formula too. It's so.
And we'll put that we will put this formula in.
Yeah, we'll put this below so you can understand it. But now that comes out to $400. Okay.
Oh, okay. Then I would take the 6,000 because I'm not over 50, subtract that 400, and that brings me to 5,600.
So your maximum reduced amount, Michelle, that you're allowed to put in for the year is 5,600, $400 less than the 6,000 for everyone else.
Okay. And again, we'll put the formula below because it's a lot.
But
what happens? So what happens if I pass the phase out range?
Oh, great question.
So let's go back to this. It's 144 is the cap, right? A penalty.
Well,
what does it look like?
Michelle, it's a 6% penalty per year for every year the excess funds remain in the Roth IRA. Okay. It's terrible. You got to stay on top of this. And let me explain it first, and then let me give you my opinion on this. Okay. So what this means, Michelle, you have to remove the overages and the interest earned by that year's tax filing date. So we talked about the tax filing date up till April of next year, right, of 2023.
Right.
Okay. So Michelle, if you put in $6,000 and you're only allowed 5,600, the excess is $400. We're going to charge you a 6% penalty for every year, which is $24 for the excess amount in there.
Yeah. Okay.
But don't forget, you put in an extra 400. What about the interest you earn on that 400?
You have to pay it on that too. Okay.
You got to pay the penalty on that also.
Okay. All right. Thank you for explaining phase outs. Appreciate it. And again, we will put that formula because it's important. You pay attention because no one wants to pay the government 6% on anything. I know I don't. Right. Okay. So what are the withdrawal rules for the Roth IRA?
Oh, okay.
Break those down.
I love the Roth IRA for the tax-free withdrawal. Okay. But Roth IRA, tax-free withdrawal, and IRS penalty rules vary depending on your age and how long you've held the account. And there's some other factors, but the main thing is you've got to take your withdrawals after the age of 59 and a half.
Okay.
Withdrawals must be taken after a 5-year holding period. So there's the key. Holding the account for 5 years and being over the age of 59 and a half. You know, there are some exceptions, though, to the early withdrawal penalty, such as first-time home purchase, college expenses, birth or adoption expenses. And, you know, in Congress right now, they're trying to add some additional ones based on some healthcare narratives that are out there today. So.
Okay, let's break it down. Roth IRA withdrawal rules. Wow, that is a mouthful. Roth IRA withdrawal rules if you're under age 59 and a half.
Okay, if you're under 59 and a half, you can withdraw your contributions you made to your Roth IRA at any time. And they're going to be tax-free and penalty-free. Why? Because you've already paid taxes on them, okay? But you may have to pay taxes and penalties on earnings in your Roth IRA depending on your situation. So if you take withdrawals from a Roth IRA, you've had less than 5 years. It's a distribution of your earnings before you reach age 59 and a half and before the account is 5 years old. The earnings may be subject to taxes and penalties. You may be able to, I'm not going to say can avoid, you may be able to avoid penalties, but not taxes in the following situations, okay? You can use the withdrawal up to a $10,000 lifetime maximum to pay for a first-time home purchase. We use this scenario quite often for our consumers. Okay. You use the withdrawal to pay for qualified education expenses, and you use the withdrawal for qualifying expenses related to a birth or an adoption. Also, you use the withdrawal to pay for unreimbursed medical expenses or health insurance if you are unemployed.
Okay, so that one applies to if you're unemployed. If you're employed, no.
If you're unemployed.
Yeah, but I'm saying if you are employed and you have,
yes.
Okay, then you have to pay.
Yeah.
Okay, so what if you take withdrawals, but you've had it for more than 5 years? What then?
Okay, if you're under 59 and a half and the Roth IRA has been open for 5 years or more, your earnings will not be subject to taxes if you meet one of the following conditions. Same thing. First-time home purchase up to $10,000, withdrawal to pay for higher educational expenses, qualified expenses related to birth or adoption, and pay for unreimbursed medical expenses or health insurance, even if you're unemployed.
Okay. All right. Got it. Okay. All right. What else do we need to know about withdrawal?
If you're over 59 and a half, here's the big one, and you take withdrawals from a Roth IRA, you've had less than 5 years, your earnings will be subject to taxes, but not penalties if you've met the 5-year holding requirement. And if you take withdrawals from a Roth IRA, you've had more than 5 years, you can withdraw with no penalties, taxes, as long as you've held it for more than 5 years.
So basically, if you qualify for a Roth now, right, it's a great financial move because for retirement savings specifically because of these tax-free distributions. There's no RMD, right? There's no required minimum distributions, which is big. I think is a big thing as well. They have better terms for early withdrawals than a traditional IRA. And that, you know, if you're currently estate planning or looking at it or want to make sure you don't screw your kids, tax-free withdrawals for heirs. Is there anything else you want to add before we wrap this up?
Yeah, 2 quick things. One, first, open a Roth. It's that simple. Okay. Second, the importance of this video today really shows you what you need to look for in an advisor.
Yeah.
Okay. Advisors are required to put a disclosure at the bottom of every blog post, at every Facebook post, or whatever they do, every piece of advertisement, saying that they're not giving tax advice.
Right.
What is the number one thing we've talked about with opening a Roth IRA today, Michelle? Taxes. Okay. So advisors are required to put a disclosure out that they don't do taxes and aren't giving tax advice, but they're opening an account that offsets taxes in retirement. So it's a catch-22 that advisors are in. One thing I've always done in my 24-year career is I read a person's tax return to understand if a Roth IRA makes sense. And you, as an advisor, if you are giving tax advice by opening up a Roth IRA.
Right.
So but in all honesty, it's okay. Just make sure you work with someone that understands and reads your tax return. Make sure that this is best for you and open a Roth IRA today.
Okay, perfect. Thank you, Brian. Thanks to everybody who made it to the end. If you like the content of this video, hit that like button. Please hit that thumbs up. What's it called? Thumbs up button, like button. I don't know. That thing, right? And also don't forget to subscribe so you never miss another video from us. Thanks everybody for watching. And thanks so much, Brian.
Thanks, Michelle. Thanks, everyone. Have a great day.